Very good evening, all of you. Can you please confirm if my audio and video is clear and you can see the screen with the notes? Fair enough. Okay, so I welcome you to the 5 days revision session for ACCA Strategic Business Reporting for December 22 attempt. So in this we will have a 5-day sessions, and also every day we'll try to practice certain questions also after discussing the concepts. We will not be discussing the much in detail about any about anything, but yes, we'll discuss everything which is relevant for the exams. Okay, now you can definitely post your queries in the comment box if you have anything, but yes, your queries should be restricted only to the topics which we are discussing. That's the only points I want to tell you guys. So on that note, let's start the class. So the topic that we are going to discuss today is leases and non-current assets, and if the time permits, we'll see we'll practice also a question definitely. Now, so topic 1 will be leases, that is IFRS 16. So guys, understand very logically, when we take anything on a lease, what do we do? We take the right of use of that, right? We have the right to use that thing, right? Now we have the right of use of what, right? So we have the right of use for the identified asset. Okay, now when we have the right of use for the identified asset, right, do we get it for the whole life? No, right? So that is for a specified period. Okay, so my sound is low, just give me a minute. Let me check the sound settings. Hello. It's at the top level for me. Can you please check? Can you please increase the volume of your system so that we can be at the same page? Okay. Is it better now? Guys, if you can confirm, is it better now, the voice? Okay, no worries. Okay, I hope it should be better now. So understand, guys, what is a lease? So as I was discussing that basically when we talk about a lease, in the lease we get the right to use something, right? And that is an identified asset. So if we see here, we get the right to use of an identified asset. Now definitely we have to discuss what is the meaning of an identified asset, but we'll discuss definitely in this one, step number 2. But before that, we understand whenever we are getting the right to use, okay, but what happens, that right to use is not for the whole life, right to use is not for the whole life, right? But what happens, we get it for the specified period, okay? And we don't get it for free, we get it for a consideration, we take it for a consideration, okay? So that's the definition of a lease. Now in the exam, will they ask the definition? No, they will definitely not ask you the definition. Then what will they ask? See, they might ask you to prove whether the contract which is there is a lease contract or not. So how to prove whether the contract is a lease contract or not? So see, this is the meaning. You have to apply this meaning itself to assess whether that contract is a lease contract or not. But now standard gives you the better guidance for that. How? What standard does is standard breaks these three into three steps. And that is called as, first step is identified asset. There should exist an identified asset. Okay. There should exist an identified asset. Now when we talk about an identified asset, understand, guys, standard says two things. And now what are those? So they are, first, the asset should be specified. Now what is the meaning of asset should be specified? The asset should be either explicitly or implicitly specified. Understand, guys? Assets should be explicitly or implicitly specified, meaning thereby, let's suppose I am taking any asset on rent, okay, and in the lease contract it is written that this is the asset which I am getting. That is called as explicitly specified. Now, if the contract doesn't say anything that which asset I will get, but both the lessee and the lessor knows that which asset they are going to transfer, okay, that is called implicitly specified, though not specified clearly, but yes, they both know it, okay, that is called implicitly specified. Now, coming to substantive substitution rights. Understand, guys, what is the meaning of substantive substitution rights? So standard says that first thing, lessor should not have the substantive substitution rights. Lessor should not have the substantive substitution rights. Now first understand what is the meaning. The meaning is the lessor should not have the right to substitute the asset during the period of use by the lessee. Why? Let's suppose I take any asset on rent, okay, and the lessor exchanges. You can say the lessor substitutes the asset every now and then. Tell me, do you think you control the asset? You control the asset? No, you don't control it, right? You don't control it, right? So what happens? What does the standard say? Basically that the lessor should not have the, I'll write it off like this. Lessor should not have the practical ability. Lessor should not have the practical ability to substitute the asset. Okay. Plus, lessor should not have the practical ability. No. Plus, lessor should not have the economic benefits. Even if the lessor has practical ability, lessor should not have economic benefits from this substitution. Lessor should not have the economic benefits. So what does it mean? If the lessor is having the practical ability to substitute, plus if the lessor is having the economic benefits also on the substitution, then we say that the lessor has substantive substitution rights. And if lessor has substantive substitution rights, it won't be called as an identified asset. If it is not an identified asset, it will not be called as a lease. Are you understanding the point? So what I'm trying to say here is lessor should not have substantive substitution rights, and if lessor has the right to substitute the asset substantially, then that's not an identified asset, and if it's not an identified asset, it's not a lease. Okay, now coming to the second part, it is right to direct the use. Now understand, guys, whenever, let's suppose I have this pen and I say that I control this pen. When I say that I control this pen, so don't you think I have the right to decide that how I want to use it, right? For what purpose I want to use it, right? So I'll write the meaning of right to direct the use is I have the right to decide. That how and for what purpose I will use this asset. How and for what purpose I will use this asset. Okay, basically it says the right to direct the use. See, when you take the asset on lease, you get the control for that period. Right? You get the control for that period. Understand this term. You get the control for that period. Now, when I say that you have got the control, okay, you should have two things. You should have two things. One, the right over that asset, plus right to direct the use. Second, right to receive all economic benefits. Right? Now understand, in the lease contract, tell me, guys, all of you, please tell me, in the lease contract, what have you got? You have got the right to use, or you have got the whole ownership? Tell me, all of you, please. Come on. We have got the right to use. Very good, Karima. Very good. So if you have got the right to use, don't you think the economic benefits which you will get, will also be only and only from the use? Right? So that's what the standard says. It says basically you should have the right to receive all the economic benefits. Now, if I'm saying all the economic benefits, does it mean all the economic benefits? No, it means only from use, only from use of the asset, only from use of the asset, only from use of the asset. Now, when all these three conditions get satisfied, we say that the contract that we have entered into is a lease contract. The contract which you have entered into is a lease contract. Now, the question might ask you to assess whether the contract which a customer has entered into or a party has entered into is a lease contract or not. So what will we do? First, you have to define what is a lease. Okay. Then you have to analyze these three conditions and say that, okay, that if all the conditions get satisfied, right here, if all the conditions get satisfied, you have to say that yes, this is a lease contract. If even a single condition doesn't get satisfied, let's suppose it is not an identified asset, then it will not be a lease contract, or it doesn't have the right to direct the use, it is not a lease contract. All the conditions has to be satisfied for it to be classified as a lease contract. I hope it is clear to everyone. Guys, if you have any queries, do post it then and there, okay? Now, comes the third point, that is lease term. Now, what is a lease term? Understand, guys. Okay. Now, I assume there are no queries so far. Okay. Moving forward. Now, lease term. Understand, guys, the lease term are of two types. The one where both the lessee and the lessor can cancel the contract at any given point of time. And the another is non-cancelable. Basically, when neither the lessee nor the lessor can cancel the contract. Neither the lessee nor the lessor can cancel the contract. Okay. Now, understand, guys. Okay. So when the lessee and the lessor both can cancel the contract at any given point of time, do you think there is any boundation by the lessee or the lessor? There is any boundation by the lessee or the lessor? Tell me. There is any boundation by the lessee or the lessor? Tell me, guys. Any boundation? No. Ideally, no. Right? Why? Understand, guys. All of you, please understand. Basically, what happens when either of the parties can cancel the contract without the intimation to the another party? What happens? Basically, let's suppose I have taken a asset on lease. And when I take that asset on lease, okay, I say that this is a cancelable contract. Basically, the lease term is a cancelable lease term. There is no non-cancelable period. Then what happens basically in that is, what if the lessor comes one fine day and says that I am cancelling this contract here itself? Don't you think this condition will get impacted? More or less, right? Right? The lessor has the right to cancel the contract. So means there is no boundation, means this is not a lease contract. Right? So I'm not covering the cancelable period. So we will be covering only the non-cancelable period. Okay, that is non-cancelable lease term, plus the renewal option. What is the meaning of renewal option? Let's suppose the lease contract says that this contract of 5 years, this lease contract is of 5 years. If the lessee wants, they can extend it for a further period of 5 years. This option is called as renewal option. Now, why are we adding it up? Why are we adding it here? The reason is, if the lessee is reasonably certain, see, RC means reasonably certain, means lessee assesses that yes, if I exercise this option, the benefits will be greater than costs. Okay, benefits will be greater than costs. Then I will say that yes, this option is beneficial for me and it's better that I opt for this. Okay. Now, so that it is in that case, I will add this one in the lease term. Now, plus purchase option also I am assessing. Now understand what is the meaning of purchase option. We'll discuss this in detail when we'll discuss the future lease payments also. Understand guys. Okay, I'm parking it for the future lease payments part, then we'll discuss it off there. Now coming on to the measurement point, measurement in the lessee books. So far we have discussed three things. One being the meaning of lease or the definition of a lease. Second being the identification whether the lease contract or the contract which we have entered into is a lease contract or not. Third thing is the lease term. I hope all these 3 points are clear to all of you. Please confirm guys. What about termination period? Ahana, I'll definitely come on that point. Okay. Now moving on to the fourth point, that is measurement principles. Now understand guys, when we have to do the measurement principles, understand the measurement principle is quite easy, is quite easy. Understand what happens basically when you purchase any asset, what do? You record the asset and you record the payment. When you purchase any asset for credit, what do? You record the asset and you record the liability. Agree? Now, when you purchase any asset on EMI, what do? You record the asset at the present value of the future payments, right? You record the asset at the present value of the future payments. Now, when we take the asset on lease, what is happening, guys? We are also getting the control over the asset, but only for the specified period of the life of the asset. See, let's suppose this is the life of the asset. This is the useful life of the asset. But when we get the control over that specific period or a specific portion of the whole useful life, so what do? We record only that part as an asset. So how do we do that? Okay, basically what we do is we calculate the present value of all the payments that we make to the lessor. We calculate the present value of all the payments that we make to the lessor. Okay, now, so initially we record what? Two things, and one asset and second a liability for the payments to be made over the lease period, right? And now how do we record the liability and the asset? Understand guys, everyone, all of you please. So measurement will be two things, initial and subsequent. So let's understand the initial measurement first. All of you please concentrate here in the class. The lease liability. So the lease liability, as we discussed right now, is the present value of the future lease payments. Okay. Now definitely you must be wondering with 2 points. What is the meaning of future lease payments and how do we calculate the present value? Okay. Definitely let's understand these points. Come here. Future lease payments. See guys, understand future lease payments can be of 2 types. It can be fixed, it can be variable. Now, what is the meaning of fixed and variable? Let's understand this. Now, fixed is again divided into 2 parts and variable is also divided into 2 parts. Now, let me take up an example for each of the parts and understand guys, okay? Now, understand. I'll give you example for each of the part. So, first let's discuss the fixed portion and then we'll discuss the this one, fixed portion, pure fixed. If I say that the rent is $10,000 per annum, okay, this is called fixed. And the fixed will form part of the future lease payments which we will be considering, for calculation of lease liability. Now comes semi-fixed. What is the meaning of semi-fixed? Understand, $10,000 per annum or $10,000 per annum or 20% of cash flow generated from use of asset. Now understand guys, this 10,000 per annum and or 20, whichever is higher, I'll write here whichever is higher. Now I will give you 3 situations. Let's suppose 20% of cash flow. 20% of cash flow comes to, let's suppose, 8,000 or 9,000 or 12,000, let's suppose. Okay. Now this is a fixed payment, that is 10,000 and 10,000. Now what we have to pay? We have to pay the higher of, right? So in this situation we'll pay 10k. In this situation also we'll pay 10k. In this situation we'll pay 12k. So what happens here, guys? What happens here? What we are doing here is, we are in all the three cases, a bare minimum of 10k is paid every year. Are you understanding it? A bare minimum of 10k is paid every year, right? So this 10k forms the fixed portion, and the rest, that is the 2k here, 2k is the variable portion. So what we will do, we will consider the fixed portion, that is the 10k, for calculation of our lease liability. The remaining 2k will be recorded as a rent expense in the P&L on an actual basis, okay, in the year in which it is paid. Now coming to second point, the variable. What is the meaning of variable lease payments? Guys, again, the variable are again of two types. One is pure variable. Pure variable, the example can be 20% of cash flow generated from use of asset. Now apply your logic and tell me, guys, standing on the date when you enter into a contract, or standing on the lease commencement date, okay, do you know that what is the cash flow that you will be earning from this asset in the future over the lease period? No, you don't know, right? So you will not be able to compute this one. Even if you can estimate it off, there will be a higher level of estimation and the amount will be uncertain, right? So we cannot calculate the present value of that, right? We cannot calculate. So this amount we will not be considering. This amount, this variable lease payments will not be considering. In the calculation of lease liability. Now comes variable linked to index or a rate. Guys, understand guys, whenever we take a asset on lease for a longer period, like let's suppose 10 years or 20 years or 30 years, right? Generally in the case of real estate properties, does the rental remain constant over the lease period of 20 years? No, it will increase definitely, right? Now it can increase in multiple forms. Like for example, you can say 10% every year, right? 10% every year, or it can increase in line with the CPI, that is inflation in the country, right? Consumer price index, it can increase in line with the inflation in the country, or inflation is you can say denoted by CPI, right? Consumer price index, it can increase in line with that also, right? So those if the lease payments is variable due to this factor, that is index or a fixed rate, yes, it will form part of lease liability. Definitely, then you should have a question here. You should ask me a question here. Sir, if it is variable, how will we estimate today? No, we will not be doing it. What we do is, based on the present inflation rate, we'll calculate what are the future lease payments, and we'll calculate the present value. Let's suppose in the future the inflation rate changes and accordingly the lease payment changes, we will remeasure our lease liability. And which is the next point which we have to study. Okay, I hope it is clear everyone so far. Now additionally, understand guys, additionally future lease payments also includes guaranteed residual value. See, understand guys, what happens in a guaranteed residual value? The portion of residual value which is guaranteed by the lessee to the lessor. It's not the whole residual value. It's only the portion of residual value which is guaranteed by lessee to the lessor. Okay. So we will include this also in the part of in the future lease payments. Purchase price. Okay. Now, see, we will consider the purchase price only if purchase option exists. Okay, and lessee is reasonably certain. Again, reasonably certain means benefits are greater than costs. Let me give example. Let's suppose lessor is stating in the lease contract that lessee can purchase this asset at the end of the lease period at a price which is sufficiently lower than the market price. Don't you think you will purchase it off? Let's suppose I have taken this studio on rent okay, for 10 years, and the lessor tells me that Vishal, you can purchase this studio at the end of 10th year, as this studio will not be of any use for me, okay, and I know this market value of the studio will be somewhere in the range of 20 lakhs, and I will get and the lessor is ready to give me the studio at 1 lakhs. So don't you think I'll purchase it off, right? Because I know I'll require the studio, and I'm getting it at a sufficiently lower rate, so better purchase it off, right? So in that scenario, it will be called as reasonably certain, okay. Now coming to penalty, if the lessee is again reasonably certain to terminate. Now if lessee wants to terminate the contract, okay. Now if lessee wants to terminate the contract, again we'll see if which the lessee is reasonably certain to terminate the contract. Might be a case that the lessee believes, that termination is better for him. Terminating the contract is better for him, right? Terminating gives more economic benefits than to continue it, okay. So in that case, we will consider the penalty amount to be paid. Why penalty? Because if you can recall, in the lease term we considered non-cancelable period. What is the meaning of non-cancelable period? Means the lessee or the lessor cannot cancel the contract within this period, and if they cancel, they have to bear a penalty for that. Is it clear? So if the lessee believes that yes, I will have to pay penalty, definitely that penalty will also form part of the lease liability. Now coming to this point again, so I believe you guys are clear on this one. You guys are clear on just a minute. Just give me a minute, guys. You guys are clear on the present value of the future liability part. Now future liability, future lease payments are clear. Now let's understand the meaning of present value. How to calculate the present value? For the calculating present value, we definitely need a discount rate. Right? Now what discount rate shall I use? So for that, the standard says there are two options. One is incremental borrowing rate of lessee, and another is implicit rate of return of the lessor. What is the implicit rate of return of the lessor? Basically, implicit rate of return is nothing but the return of from this contract for the lessor. But do you think lessor will disclose the return percentage from this contract to lessee? Do you think lessor will disclose this return percentage? No, lessor will never disclose that. Ideally, in ideal scenarios, lessor will not disclose that, right? So though the standard says that priority 1 should be given to implicit rate of return of lessor, and priority 2 should be given to incremental borrowing rate, but in practical life, in practical world, it's the incremental borrowing rate which is given the prominence. Okay, I believe you are understanding this point. I hope it is clear, everyone. The present value of the future lease payments. Okay, now understand, guys. Right of use asset. Understand right of use asset. So the lease liability is clear, and now right to use asset. And now understand. Again, go back to IAS 16 property, plant and equipment. Go back to IAS 16 property, plant and equipment. When we purchase an asset, what do? The purchase price plus all the directly attributable costs, right? Plus all the directly attributable costs incurred to bring the asset in the location or condition intended by the management, plus the provision for decommissioning costs, right? Right? Now, same thing is happening here, dot to dot, same. See here. Lease liability is the purchase price, the price which you are paying to get the control, plus initial direct costs, right? The directly attributable costs incurred to bring the asset in the location or condition intended by the management. Upfront lease payments. What if I have paid one lease payment today itself? Right? Now upfront lease payments, because whatever I paid today, definitely it will not form part of my lease liability. I hope you are understanding, guys. I hope you are understanding, all of you. Okay, minus lease incentives. If we get any rebates or discounts, remember IAS 16 again, if we get any discounts or rebates, we deduct that as well, right? Plus provision for decommissioning costs. Okay, understand, guys, even the standard says that this ROU asset, right of use asset, which we will be calling as ROU asset, works on the principle of IAS 16. Okay, IAS 16. Okay, so always apply the principle, always apply the same principle, apply the same principle. I believe the initial measurement is clear to all of you. For a lease, I believe the initial measurement is clear to all of you. Now moving on to subsequent measurement, understand guys, for a lease liability, what do we do? Lease liability is what? It's an obligation to pay. It's a contractual obligation, because a lease is a contract and this liability is an obligation. So it's a contractual obligation to pay. It's a contractual obligation to pay in cash or any other financial assets, right? So don't you think it's a financial liability as per IFRS 9 financial instruments? It's a financial liability as per IFRS 9 financial instruments, right? Now, how do we record financial liability at amortized cost method? If you can recall IFRS 9 or financial instruments, we record it at amortized cost method. And what do we do in amortized cost method generally? Basically, what we do here is opening lease liability plus finance costs minus the lease payments is equals to closing lease liability. Now, Nutan has a query. If lease incentive is received in second year, will be calculated to PV. Yes, Nutan. If it is received in second year, it will be calculated in PV. Okay, we'll be considering that in the present value. Okay. Now understand, guys. This lease liability will amortize basically opening lease liability plus the finance cost on lease liability minus the lease payments is equals to closing lease liability. Now this right of use asset is as per IS 16. Now tell me, how do we measure as per IS 16? We depreciate it over the useful life. Now what is the useful life of an ROU asset? Tell me, guys, what is the useful life of an ROU asset? Useful life of an ROU asset, that's a lease term, right? That's a lease term. Let's suppose this is the useful life of the whole asset, but we have taken the asset on a lease only for this period, right? Only for this period, and we are recording the asset only for this period. So the useful life of this asset is only this term, right? So useful life is the lease term, so we will depreciate over lease term. But understand, what if the in the lease contract there is a purchase option, and the lessee is reasonably certain to exercise the purchase option. Don't you think it should be depreciated over the remaining useful life on the date of the lease contract? Because I will be purchasing. See, let's suppose my lease term is 5 years. Okay, my lease term is 5 years. After that, I have an option to purchase the asset. Right? So I will definitely purchase it that. So I will be using throughout the life of the asset, throughout the remaining life of the asset, right? Plus, if you see in the cost part also, if the purchase option is reasonably certain, if you see here, in the cost part also, I am including the purchase price. If lessee is reasonably certain for this purchase option. So don't you think I should depreciate it over the remaining useful life, right? Rather than depreciating it over the lease term? Because see, how do we calculate depreciation? We calculate depreciation generally as cost by life. If the cost also includes purchase price, so the life should also include the remaining useful life. I believe you are understanding this point. Is it clear, guys? Everyone, please come on, tell me. Okay. Now moving forward. So see the journal entry for the lease contract. See the journal entry. We record the asset. See, is the journal entry again following the concept of IS 16. We record the asset. We record a liability. If we have paid any direct cost, we capitalize that to the asset, right? If we have any provision for decommissioning cost, we'll record that as well and capitalize it to the asset, right? It's the same principle, right? So lease liability is what? Let's quickly discuss it off. It's the present value of future lease payments. Bank is what? Initial direct cost minus lease incentives. Provision for decommissioning cost, you already know. This is the total of it. I believe you are understanding this point. All of you? Now, fair enough. Now moving on to the next point, that is lease remeasurement. Now what is lease remeasurement? Generally student faces a struggle in this point, lease remeasurement. They ask me, sir, what is this lease remeasurement and why do we do lease remeasurement? Understand guys, all of you please concentrate here. When measuring the lease liability, we estimated lot of points, we estimated lot of things, like for example what, tell me. See, this is your calculation of lease liability, I'll mark it with this pen, okay. Now what are the estimates that we used? See here, guaranteed residual value, don't you think this is an estimate, right? Residual value itself is estimate, right? When I'm purchasing this asset, and I'm saying that okay, this asset will have a residual value of 5,000, don't you think that's an estimate? A portion of which will also be an estimate, right? So residual value is an estimate. Do you know certainly that at what price you will be able to sell this asset at the end of the life of this asset? No. So residual value is always an estimate. Now again, come here. See, when the lease payments should change according to the change in inflation, don't you think that's again an estimate? Right? Inflation rate in the country is again an estimate. Inflation rate in the country is again an estimate. Tell me yes or no? Right? Inflation rate in the country is again an estimate, right? So now, basically, now again, one more estimate. This option. See guys, understand, when I took the asset on lease, I thought that okay, I might purchase this studio. I will purchase a studio. But going forward, let's suppose 2 years passed by out of 5 years of a lease contract. 2 years passed, and then don't you think my mind might change? Okay, my mind might change that okay, I want to shift from Bangalore to Delhi. Okay, now if I want to shift from Bangalore to Delhi, do you think this studio will be of any use for me? This studio will not be of any use for me, right? So in that case, I might become not reasonably certain. Now if I become not reasonably certain, again this is change in estimate. Right? So what I am trying to say here is, your estimates might change during the lease period. And if your estimates change during the lease period, you will be required to remeasure the lease liability. Now, how to remeasure? That is the question. I have simplified it in 3 steps, only 3 steps. See, if you have to remeasure, what you have to do is, first, on the date you think the estimates are changing, or in the date when you have to remeasure it, first calculate what is the carrying amount of your lease liability and what is the carrying amount of your ROU asset on that date. Okay. Now first calculate the carrying amount. Okay. Now see, now you have to remeasure. And how will you remeasure? What you will do, see, whenever we change estimates, tell me, do we go and change retrospectively? Tell me, do we go and change retrospectively? Whenever estimates changes, do we go and change retrospectively? No, we don't change it retrospectively, right? So standard says, whenever your estimates changes, what you have to do here is remeasure lease liability. For that you need 2 things. What are the revised lease payments? And what is the discount rate? See, you have, for remeasuring the lease liability, you need revised lease payments. See, why I am saying revised lease payments? I'll give you. The lease payments might revise. Why? Because your residual value might change. So your guaranteed residual value will change, right? So if your guaranteed residual value changes, your lease payment will change. Tell me yes or no? Now, if your CPI index changes, I'll write here CPI as well. CPI. If your inflation rate changes, don't you think your lease payments will change? Right? So again, your lease payments will change here. Now understand again. If exercising options, let's suppose I had the plan to exercise the renewal option. Okay, so I had the plan, this plan C, 5 years was the lease period, plus there was an initial renewal option for 3 years, and I was originally I was reasonably certain that yes, I will exercise it renewal option. So I consider the lease payments of 5 years plus 3 years. Now after 2 years has passed, I believe that no, I will not be exercising this option. So now don't you think though I will have a lease payments of 3 plus 3 6 years, but I will now consider the revised lease payment only for 3 years. Are you understanding what I am trying to say? All of you, are you following up with me? Okay, now so I have to remeasure my lease liability using revised lease payments, but considering the original discount rate, don't forget this guys, this is a very important point, but considering the original discount rate. Okay, original discount rate means what? The discount rate on the date of on lease commencement date. Okay, on lease commencement date. Now see, you have the original value of lease liability, the carrying value of lease liability, and you have the remeasured lease liability. Now calculate the difference of both. Okay, calculate the change in the lease liability, that is step A minus step B. And now whatever is the difference, mark my words guys, whatever is the change in the lease liability, we will make a corresponding change to the ROU asset. What is the meaning of corresponding change? Means if liability has increased by X amount, I will increase my ROU asset also by X amount. Okay, I will increase my ROU asset also by same amount and same magnitude. Means if lease liability is increasing, I will increase ROU asset also. If lease liability is decreasing, I will decrease my ROU asset also. If lease liability is increasing by X amount, I will increase my ROU asset also by X amount. That's the meaning of corresponding change. The same amount and the same magnitude. Okay, is that clear all of you? If the rate has been changed after 3 years. Siddhant, the whole reason behind that, if we consider the revised discount rate, what will happen? It will have the retrospective effect also. It will take the retrospective effect also. Okay, so we don't want to. So what we want to do, see what I'll tell you again, to answer it other way around. If we change the discount rate, the whole substance of the contract will change. Now see here, in this case, guaranteed residual value changes, right? Now do you think this is something substantial? Tell me. Do you think this is something substantial? If your guaranteed residual value changes, is it something substantial? No. So that's the reason why standard wants you to take the original discount rate. But the standard says if something substantially changing, right? You have to consider revised rate. Now see, I have given you 4 things. In these 4 things, tell me what are the substantial things. Change in guaranteed residual value, is it something substantial? No, not substantial. Change in the exercising options, like a purchase option, like a renewal option, or like termination option. Like if there is a change in the reasonable certainty of these, okay, then this is something substantial. Lease term changes, this is something substantial. CPI changes, okay, now this is again something substantial, right? So again, when something substantial changes, standard now goes on to state that you will use revised discount rate. Nutan, is there any chance of de-recognizing decommissioning costs Why we will de-recognize decommissioning cost, Nutan? Because in remeasurement, change is only in lease liability. Yes, so the change in lease liability, so we are making the corresponding change to ROU asset, from where the question of decommissioning cost comes up, Nutan, here. Decommissioning cost is as it is capitalized to the asset, right? That is untouched. That is untouched. We are not changing that, right? That remains untouched. That remains untouched. Understand? Decommissioning cost is altogether a separate obligation, right? Not payable to the lessor. Not payable to the lessor. We are discussing what is some estimate changes pertaining to the payment to the lessor. Okay. I hope it is clear, guys. Tell me, is remeasurement clear to everyone? Understand, guys, for remeasurement, calculate the carrying amount, calculate the revised lease liability, calculate the revised lease liability considering revised lease payments but original discount rate, calculate the change and make a corresponding change to ROU. Okay. Now, if the change in estimates is something substantial, like change in the exercising of options, or you can say the change in the lease term, if this is the change, this is something substantial. So in this case, when you are remeasuring your lease liability in step number 2, what you have to do here is you have to remeasure your lease liability using revised lease payments and revised discount rate I hope it is clear to everyone, the lease remeasurement. Please confirm, everyone, all of you, please. Now, coming to the, see, this is all from a lessee point of view. See, I'll again quickly summarize whatever I have discussed so far. Understand, guys, first we discussed the meaning of lease. What is the meaning of lease, right? Why change in GRV is not substantial? Okay, now tell me, Siddhant. Here, this is your future lease payments, right? These are future lease payments, and the future lease payments has 6 components. Has six components. Why? What are the 6 components? See here. Component number 1, component number 2, component number 3, component number 4, 5, 6. Out of 6 components, just 1 component is changing. Out of 1 component, just 1 component changing. And now, this guaranteed residual value is also a very minimal amount. This guaranteed residual value is also a very minimal amount. Okay, is very minimal amount. Right now, see what are other things. Option changes means what? I was having a purchase option, but the purchase option is not there. This is something substantial. I was having option to renew, which I was reasonably certain for again next for 5 years was the original lease contract. I was having a renewal option for 5 years, but now I am not taking it off. So now 5 years lease payments will go off. Something substantial is happening, right? Something substantial is happening. Again, what else? Now CPI, the whole lease payments will change. Due to CPI, the whole lease payments will change, right? So these are substantial, Siddhant. Okay, I hope you are understanding, right? So now again, I was just giving you a quick summary. So first we discussed the meaning of lease, which had 5 components. Then we discussed about the identification of a lease, whether the contract which I have entered into is a lease contract or not, and that has 3 components, that is identified assets should exist, right to direct the use, and then the right to receive the economic benefits from use of the asset, Now then we started the lease accounting in the books of lessee, where we told that initially we will recognize a lease liability and a ROU asset. Okay, then we discussed about the measurements, and then we discussed about subsequent treatment of lease liabilities, which will be as per IFRS 9, that we will amortize it, and for ROU asset we'll depreciate it over the useful life, as for the lease term, but it can be depreciated over the remaining useful life if there is a purchase option and the lessee is reasonably certain to exercise the purchase option. Then we discussed about the lease remeasurement. Which will be done when there is a change in the estimates. So for which we'll calculate the carrying amount, we'll calculate the revised, we'll calculate the change, we'll make a corresponding change. Now coming to discount rate, if there is a change, if something substantial is not changing, we'll use original discount rate. If something substantially changing, we'll use revised discount rate. I hope it is clear everyone so far. I hope it is clear everyone so far. Okay, fair enough. Now let's move on to lesser accounting. Let's move on to lesser accounting. Okay, lesser accounting. See, unlike lessee accounting, which was a single lease accounting model, unlike lessee accounting, in lesser accounting, we have to classify the lease contracts at two parts. Either operating lease, either it can be an operating lease or it can be a finance lease. Okay, so we have to classify the contract as either an operating lease contract or a finance lease contract. Now comes the question, how will we do that? So I will give you first a basic understanding, and then I will tell you the conditions which the standard says. Basic understanding. If you think that you have taken the asset for a rental for a specified period, that is an operating lease. Okay, if you think you have substantially sold the asset, okay, think from the point of view of lesser, okay, think from the point of view of lesser. If the lesser feels that I have substantially sold the asset, okay, I have lost the interest in the asset, that's a finance lease. Okay, that's a basic understanding you should have. If you understand this one, the whole conditions will become very easy for you. Now standard gives you 5 illustrative points, indicators, 5 indicators. I'll write here, indicators. Standard gives you 5 indicators to classify a contract as a lease, as an operating lease or a finance lease. And what are those 5 indicators? See, if the asset's ownership will be transferred at the end of the life of the asset. Don't you think you have lost interest in the asset? Right? You have lost interest in the asset, right? So that is called as finance lease. Now, purchase option exists, and the purchase price, and it is reasonably certain. You can say purchase option exists and it is reasonably certain. Again, it is finance lease. Okay. Now, the lease term is substantially equals to the useful life. The lease term is substantially or approximately equals to the useful life. Again, it's a finance lease. Okay. If the present value of the future lease payments is equals to the fair value of the asset, basically the amount which the lessee is paying, the present value of that is substantially equals to the fair value of the asset. Means, let's suppose I have this asset. The cost of this asset or the fair value of this asset is rupees 5,000. I gave this asset to Siddhant. On lease, and Siddhant will pay me the lease payments, and the present value of those lease payments comes to 4,900. So it means that I have substantially sold this asset. to Siddhant. Okay, and these type of contracts are called as finance lease contract. Okay, the asset is of such a specialized nature. That you can say it will not be of any use for the lessor. Okay, it will not be of any use for the lessor. Again, in that case, so I'll give you an example. So in this studio, I've customized it according to my requirements. The whole customized is according to my requirements, and it is done in a way that it will not be this infrastructure basically will be of no use for anyone else. Except for me. No one else can use it in a manner. Okay, in a manner I can use it, no one else can use it. Okay, so again, this is a specialized asset. Okay, so again, in this also you can say that this is a finance lease. Now can I say that this is the only indicators? These are the only indicators. See, the name itself says indicators, so it's an illustrative list. It's not an exhaustive list, it's an illustrative list. I hope you're understanding, everyone. Now, Once you classify whether the contract is a lease contract, operating lease contract, or a finance lease contract. Once you classify whether the lease contract is an operating lease contract or a finance lease contract, now comes the accounting part. Guys, I think only few students are taking part in the live class, so come on guys, all of you, please raise your queries if you have anything, and please actively participate in the class. Okay, all of you, please come on. Now understand operating lease and finance lease. See, now operating lease, if it is an operating lease, the accounting treatment is very simple. It simply says record rental income, whatever income you receive, okay, in P&L on straight line basis. Though I don't need to explain what is an SLM basis, but still I will explain it in a simple manner. Year 1, year 2, year 3. Let's suppose there is a 3-year rental. Okay, the rental in year 1 is $10, the rental in year 2 is 15, and the rental in year 3 is $20. Okay, so will tell me, this is an operating lease contract. So tell me, what will the amount that will go to P&L? Let me see who can answer it correctly. What is the amount that will go to P&L in year 1? What is the amount that will go to P&L in year 1? Tell me. Come on guys, tell me. What is the amount that will go to P&L in year 1? Come on, answer space, everyone. Neha, 15. What about others, guys? Come on, answer. Siddhant, 10. Yogesh, 15. Others, come on. Answers, please. Wonderful, everyone, except Siddhant. Understand, Siddhant? Siddhant, understand. What is the meaning of straight line? So what we'll do is, first we'll do the total. So total is how much? 45. What is the lease period? 3 years. Divided by 3 years. So it comes to what? 15. So what we'll do, we'll record 15 as an income, 15 as an income. This is called SLM basis. I hope it is clear, everyone. Okay. Now come to the accounting for finance lease. Let's discuss the accounting for finance lease. Now, understand. What lessee did? It recognized the asset, and recognized the liability. Right? It recognized an asset, it recognized a liability. Now, parallelly, what will lessor do? It will de-recognize the asset and recognize the receivable. Now, de-recognize the asset. Tell me, whenever you de-recognize the asset, don't you think you record a gain or loss on de-recognition of the asset? Whenever you de-recognize anything, you record a gain or loss. Tell me yes or no? Right? Let's suppose what I told, this finance lease is in the nature of sale. Right? So when you're selling, you should definitely record gain or loss on the sale. Right? So you should record gain or loss on finance lease. Is it clear, everyone? So we should record lease receivable how? Present value of future lease payments plus unguaranteed residual value. Tell me, why are we considering unguaranteed residual value separately? Why are we not considering guaranteed residual value here? Why only unguaranteed? Why not guaranteed also? Let me see who can answer it. Why are we considering only unguaranteed and why not unguaranteed? Already included. Wonderful. Siddhant, no. Understand, this unguaranteed is already a part of the future lease payments. I think you also wanted to say that itself. Okay. So guaranteed residual value is part of the future lease payments. So we are not adding it separately. But unguaranteed was not a part. So we are adding it separately. Okay. Now, what is the journal entry? The journal entry is lease receivable account debit, and you will de-recognize the asset, that is to asset, and the difference, the balancing figure, will be transferred to P&L. Is it clear, everyone? Is it clear, everyone? Come on, guys. Now, understand. In nature of manufacturer dealer, so standard says if the finance lease is done by a person who is the manufacturer or dealer of that person, who is the manufacturer or dealer of the person. If you can recall, guys, in childhood we used to study a topic called hire purchase. I don't know whether you are able to recall the topic or not, but yes, there was a topic called hire purchase, right? So in that topic, it was a manufacturer or dealer who used to give the asset on finance lease to someone else, right? To a customer, right? So now if I am the manufacturer or dealer of that, my business is not to do the leasing. My business is not to do leasing. My business is not to do leasing. My business is not to do leasing, but I am doing it for the sake of my for the convenience of my customer. Okay, I am doing it for the convenience of my customer. My ideal business is to sell the assets, but if I am doing any, if I am doing in this one, so don't you think it will be called as a sale on EMI model? It will be called as a sale on EMI model, right? So what do we do? Whatever amount I am supposed to receive, from the customer is my revenue, that is present value of future lease payments. Understand, guys, I have not taken here unguaranteed residual value. Why? Because this is not the amount which I will recover from the customer. I will recover only the present value of the future lease payments. Okay, I will recover only the future lease payments. So the lease receivables account debit to revenue. Now, what is the cost? Cost of selling is the carrying amount of the asset minus the unguaranteed residual value, right? Because see, let's suppose I incurred for this asset, I incurred rupees 100 to purchase. And I'm selling it off. So what is my cost? Cost is 100. Now let's suppose when I'm selling, the customer says, Vishal, I will return you this asset after the useful life. So now tell me, who will get the unguaranteed residual value part? Me, the lesser, right? So now I know that, okay, I think that this cost is 100, the carrying amount of this asset is 100, and the unguaranteed residual value will be 5. So don't you think my cost is 100 or 95? My cost is 100 or 95? Tell me. Awaiting answers, everyone. My cost is 95. Wonderful answer, Neha. Wonderful. So what I'm saying here, see. So what I'm saying here, the asset is asset minus, see, this minus this. This minus this is my cost of sales. This minus this is minus cost of sales. So what is happening? Let's suppose the asset is at value at 100. Asset is valued at 100, and the lease present value, the unguaranteed value is 5. So the cost automatically becomes 95. I hope all of you are understanding this point. Okay. So the cost of sales is what? Carrying amount of asset minus present value of unguaranteed residual value. Is it clear, everyone? Can you please see? Is this entry clear? Now, how the presentation changes? See here. If it is a normal financial lease, what will we do? In the year of finance lease, I will record a gain or loss on finance lease. Now, for every lease period, I will unwind the lease receivables and record finance income. Tell me yes or no? If it's a normal finance lease, Now, if it's a dealer, see here. In the year of finance lease, I will record a revenue and cost of sales and record finance income as it is. So now see, if you see both comparative, there is no impact in the P&L. See, this amount is broken down into two parts. That's all. This amount is broken down into two parts. That's all. There is no impact in the profitability, but the presentation changes. Now, if this person would have done this way, don't you think its revenue, this person's revenue will decrease? And revenue is a very important indicator or is a KPI for a company. Revenue is a very important KPI for a company. If revenue decreases, the share price decreases substantially, right? So these company cannot afford to decrease their revenue. This company cannot afford to decrease their revenue. That's the reason why this point is there. So this can be a question, this can be a probable question from an APM point of view, okay? This can be a probable question from an APM point of view. Now, I hope all of you are understanding this point. Okay, so we have discussed the accounting for lessee, we have discussed the accounting for lessor as well. Now moving on to the some analysis parts, some analysis, time for analysis. Now, how many of you are aware that prior to IFRS 16 there was a standard called IAS 17? There was a standard called IAS 17 which also dealt with leases. Okay, which also dealt with leases. Now understand guys, understand all of you please. What was the point given in IAS 17 and what is the change brought in IFRS 16? Understand first this one. Okay, IAS 17 says that lessee also needs to classify the contract as an operating lease or a finance lease, and the lessor also needs to classify operating lease and finance lease. This is what IAS 17 used to say. This is what IAS 17 used to say. Now IFRS 16 came. And they told that for lessee there is no concept of operating lease. There is only and only finance lease. And for lessor it remained the same. No change in lessor. Only the change was brought in the lessee. Why? Just quickly I'll answer it off. The reason is the lessee was entering into a contract of finance lease, but they were accounting for it as a operating lease to avoid the recognition of an asset and a liability. The question comes why? The question is why. See, if they will record an asset, if their asset will increase, right? Their asset will increase. Now, if the asset increase, consider the impact in asset turnover ratio. What is the asset turnover ratio? Revenue by total assets. Understand guys, if I am having the asset under operating lease or finance lease, does it impact my revenue? Tell me, all of you please. If I am taking an asset under operating lease or a finance lease, does it impact my revenue in any manner possible? Tell me. This laptop which I am using to teach you guys is taken on lease. Is it impacting my revenue? No. Whether the asset is taken on lease or purchased, it doesn't impact my revenue. But let's suppose if it is on finance lease, definitely it will increase my asset base. Right? So don't you think my asset turnover ratio will fall down? And what does asset turnover ratio represents? It represents for each money invested in the business, what is the amount of sales that the company is able to generate? What is the sales that the company is able to generate? Sales remaining constant, if the asset side increases, don't you think so? For each rupee invested, the sales will decrease. Right? Because the revenue remain constant, but the denominator increases, so the ratio will decrease. And it will show a negative ratio to the investors, which might be a negative point. Right? Now, so that's the reason. Now coming to liability, if the liability increases, don't you think the gearing ratio will increase? Right? The debt to equity, right? So equity remaining constant, debt will increase. Right? So if debt increases, again my gearing ratio will increase. Again, this will give a negative picture to my investors. Now think from the point of view P&L. See, in the P&L, it will show rent expense, and the rent expense is what? Rent expense is an operating expense. Rent expense is an operating expense, right? And these ones are non-operating expense. So what is the impact? What is the impact? So moving on to IFRS 16 will impact the operating profit margin. Moving on to IFRS 16 will impact the operating profit margin. Your operating profit margin will reduce, will increase. Your operating profit margin will increase. Your operating profit margin will increase. Okay, I hope you are understanding, all of you. Okay. Is it clear, everyone? Now, recognition exemptions. Tell me, guys, come here again. See, lessee has an option for operating lease, for finance lease. Lessor has an option for operating lease or finance lease. But for lessee, don't you think the standard has become more stringent, more strict? The standard has become more strict, don't you think so, for lessee? That you have to account for asset and liability in all the cases, right? Right? So now the standard is trying to give certain relaxations to the lessee. How? See here. So since lessor has already an option for operating lease and finance lease, but lessee don't have this option, right? So there are certain relaxations for that. Relaxations are in the case when the asset is of low value or the lease term is up to 12 months. Understand, guys, up to 12 months. When generally student makes mistake that if it is 12 months, if the lease term is for 12 months, they say that this is not it will not be availing exemption. So up to 12 months exemption is there. So that's the reason, see, I have written here equals to lease term less than equals to 12 months. Okay, lease term less than equals to 12 months. Lease term is less than equals to 12 months. Okay, so in this case, what I will do, see the treatment here, recognize lease payments as an expense in P&L over lease period on SLM basis. Tell me, guys, where did we study this? I think I can recall this. I have studied this somewhere. Tell me, guys, can anyone help me? Where did we study this point? Where did we study this point? I think I have studied this somewhere. Please help me, guys. Come on, please. Where did we study this point? Similar point. Operating lease for lessor, right? Lessor operating lease, right? There we studied, right? So same thing is applying here, So this is a relaxation given to lessee. Is it clear, everyone? Above where operating lease recognition. I didn't get your point, Siddhant. Is the question stating that so how were the lessee accounting for operating lease? So if you are asking that question, all the lease contracts were accounted in as according to finance lease. We don't need to classify itself. The lessee don't need to classify itself. All the lease contracts need to be accounted as per finance lease except for these two cases. If the asset is of low value asset, like you can say, give an example, that is laptop, okay, or mobile phone, okay, etc. Depends upon company to company, okay. So all the lease contracts except for these two situations will be accounted for under finance lease only. Is it clear, Ahana and Siddhant? I mean lesser is the same only, no, Siddhant? See here. Okay, understood your point. You were answering to my question, I believe. Okay, understood. Now, the last topic for leases, that is a sale and lease back. Understand, guys, what happens in a sale and lease back? Let's suppose I had this asset, okay, Now I am having cash issues. So what I do, I sold this asset to Neha. I sold this asset to Neha. Let's suppose, okay. Okay, I sold this asset to Neha. But when I sold this asset to Neha, my cash issues are resolved. But I don't have the asset now. So now I took the asset back from her on a lease. So what I am doing, I am first selling it off and then I am taking it on lease. First I am selling it off and then I am taking it on lease. This is called sale and lease back. Understand guys, understand. For a sale and lease back contract to exist, there must be a sale contract. Sale, what is the sale? Understand, the sale is governed by IFRS 15 and what does IFRS 15 says? It will be deemed that the asset is sold when the control is transferred. It will be deemed that the asset is sold when the control is transferred, right? So standard says that this will be sale and lease back. If the control criterion is met as per IFRS 15. If the control criterion is met as per IFRS 15. What is the control criterion as per IFRS 15? Tell me. It says control means right to direct the use. We discussed today itself, right to direct the use plus right to receive economic benefits. Right to receive economic benefits. Okay. Now this is the control criterion, right? So first this sale criterion must be satisfied. Okay, and then you are taking it on lease. Now question comes up, how to account for it? See, the standard gives you three cases. Transfer is a sale, assuming that the sale criterion is passed and the sale is happening at the fair value of the asset. Now understand. Tell me, when you sell the asset, what is general entry that you pass? Tell me. When you sell the asset, what is general entry that you pass? Bank account of debit to asset, to gain or loss on sale, right? When you take the asset back on lease, what is the general entry that you pass? ROU account debit to lease liability. Tell me yes or no. Now if it is sale and lease back, what if I merge these two entries? Tell me, is it something difficult? Tell me. Sale entry you know from class 11 itself. Lease entry we discussed today itself like multiple times, right? So you know these two entries independently. What if I merge these two entries and say it's an entry for sale and lease back? Tell me, is that something difficult? Tell me. No, right? Come here, see now. This is the entry, see. Bank account debit to bank account debit, see. I will just merge these two entries, see. Bank account, ROU account, asset account, lease liability, gain or loss on sale and lease back. Tell me if I have written even a single new line item. Tell me if I have written even a single new line item. I think no, I don't think so. Right? Now let me explain this journal entry. Tell me guys, you tell me applying your logic. In the bank, what should I write? I need answers from all of you guys. Come on, make it an interactive session. Come on, tell me, what should I write in the bank account? All of you, please answer. Nutan, Neha, Siddhant, Yogesh, Ahana, all of you, please answer. Arun, sale value. Kishala, sale proceeds. Okay, very good. Sale proceeds. See, we have written here sale proceeds. So I believe this is clear. All of you, see, you answered. I didn't answer anything. Now tell me, lease liability, how should I record? Tell me guys, come on, tell me. How should I record a lease liability? Tell me. Lease liability, Yogesh, lease liability I am telling about. At present value, very good. At present value. So this is also see present value of future lease payments, right? Now come to asset. Tell me, at what value you should de-recognize your asset? Tell me. At what value should you de-recognize the asset? Asset, I am talking about your asset. At its carrying amount. Wonderful, Arun, Neha, Kisala, wonderful answer. At its carrying amount, see, at its carrying amount. So this is also clear. Tell me, is these three line items clear, everyone? Ahana, how come sale proceeds for asset? See here. See the journal entry. Bank is sale proceeds. Asset is derecognized at its carrying amount, and the differential goes to P&L as gain or loss on sale. Right? Lease liability is recorded at present value of future lease payments. Right? So that's what I have done here. See here. Bank is sale proceeds. Lease liability is present value of future lease payments. Asset is carrying amount of the asset. Is it clear so far? Now I have to explain the ROU and gain or loss on sale and lease back. Tell me, is it clear everyone? Is it clear everyone so far? Tell me. Come on. Very good. Now understand. Before we discuss ROU asset, let's understand the logic again. Yes, Nutan, there will be a lag of 5 seconds, okay, because it's a live streaming. There will be a lag of 5 seconds. Now, okay, understand guys, understand. ROU asset, understand. I had an asset which I sold to you. I had an asset which I sold to you. When I sold, don't you think I lost 100% control? When I sold, don't you think I lost 100% control? Tell me. I had an asset which I sold to you. Okay, let me explain it here. I had an asset. This is me. This is me, VJ, right? And this is, let's suppose, Yogesh. I hope Yogesh, you won't mind me writing your name here. Okay. Now, when I sold the asset to Yogesh, I definitely lost 100% control over the asset. I definitely lost 100% control over the asset. Now, but when I took the asset back on lease, don't you think I again regained X percentage control over the asset? Right? I again regained 100% X percent control, a portion of control, not the whole asset, because I am taking on lease. I am not purchasing. I am not repurchasing. I am taking on lease. I am taking it on lease. Right? So I will not get the 100% control. I will get a portion of the control. I will get a portion of the control. Right? So don't you think so? It does make more sense to record the asset at the X percent of the carrying amount. So I should record my ROU asset. I will write it here. I should record my ROU asset at X percentage of carrying amount. Tell me yes or no, guys. Right? Now, how to calculate X percentage? What is the portion control that I have got? Tell me, how do you calculate the percentage control that we have got? What is the amount that I have paid? What is the amount that I have paid divided by what is the amount to be paid for 100% control? Don't you think in this way I can calculate the value of X? In this way I will calculate the value of X. Tell me yes or no. Right? Now, so amount paid, what is the amount that I have paid? Tell me. Don't you think this is represented by lease liability? This is represented by lease liability. Right? Now, amount to be paid for 100% control. Don't you think this is represented by the fair value of the asset? Right? So can I say carrying amount multiplied by lease liability by fair value is how I have to recognize my ROU asset? Is how I have to recognize my ROU asset? Tell me guys if it is clear, everyone. Right? See, that's what I have written here. That is what I have written here. Tell me. I hope it is clear to everyone. I hope it is clear to everyone. Okay. So carrying amount of the asset multiplied by lease liability divided by fair value of the asset. Is it clear, everyone? So that is the value which will come here as the ROU, and the balancing figure will be gain or loss on leaseback. The balancing figure will be gain or loss on leaseback. Okay. Now, if you have to understand the balancing figure logic also, it is gain or loss on, okay, or I'll write here like this: gain on sale minus loss on lease back. Okay, loss on lease back. Why loss on lease back? Why loss on lease back? Because when you take the asset back on lease, you reacquire certain percentage control. You reacquire certain percentage control, right? So you are reversing the gain. You are reversing the gain to the extent you have not disposed of your control. To the extent you have not disposed of your control. See, we recognize gain or loss only to the extent we have disposed of the control. We have disposed of the control. We recognize gain or loss only to the extent we have disposed of the control, right? Let's suppose we have sold the asset. We have sold the asset. We de-recognize 100% asset, right? So we recognize the gain or loss for 100%, right? Now when we took the asset back on lease, that is X percentage, we am de-recognizing that gain or loss. Okay, so basically it ensures that I am recognizing gain or loss only on the percentage that is actually transferred. Okay, now I hope it is clear. Now moving on to the second case, that is transfer is a sale and the sale price is greater than the fair value. Okay, sale price is greater than the fair value. Now tell me, if I will sell you some asset at a price, let's suppose the price of this asset is rupees 100 and I will sell it to you at 110. Will you do that? Will you take that? Will you take it? No. Even if you take it, you will try to recover it from me. Even if you will take it, you will try to recover the excess rupees 10 from me. You will try to recover the excess rupees 10 from me, right? So now same thing is happening here. If this person is selling the asset, let's suppose me, I am selling the asset to Yogesh at a price higher than the fair value, then Yogesh will definitely try to recover it from me. Okay, how? By way of increased lease payments. Okay, now understand. So what does the standard say for this? Understand. The standard says that, see, all the entries will remain the same except for this one. Now understand. Standard says that, see, in the bank again we write here sale proceeds. In the bank again we write here the sale proceeds. In the ROU we will again write carrying amount multiplied by lease liability divided by fair value. In lease liability again we write present value of future lease payments. In asset again I write carrying amount. This again I write balancing figure. But the amount which I have received in excess, is my liability, which I have to return by way of lease payments, right? So what I have to do, I have to calculate this sale proceeds minus fair value and record it as a finance liability, which will be adjusted from lease liability. Now let's suppose the present value of future lease payments, comes, whatever the present value of future lease payments comes, from this I have to reduce whatever is the finance liability. And then I have to disclose it as a lease liability. So I am removing of the rest because that is the same, remains the same. I am just writing this too. It is present value of future lease payments minus financial liability. I hope you are understanding this point even. I hope you are understanding these 2 points. Rest all remains the same. Even if still you want, I can write it sale proceeds, carrying amount multiplied by lease liability divided by fair value. Lease liability I have written here. Carrying asset is at carrying amount. This is at balancing figure. I hope it is clear to everyone. Right now, the third case comes, what if transfer is not a sale? Then what will we do? See, standard says, see what the standard tries to say. Meaning thereby, I have transferred the asset, okay, but the transfer does not satisfy the definition of control. But the transfer does not satisfy the control. But I have transferred the asset, I have received the money, but this transfer does not satisfy the meaning of control. Meaning of control is not there, means it is not a sale contract. If it is not a sale, can I take it on lease? No. Why? Because if the control is not transferred, how can I take a control from lease back? So it's not a lease back even. 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 If it is not a sale contract, it cannot be even a lease contract. So what about the money that we have received? What about the money that we have received as sale proceeds? See here, the whole amount will be called as a financial liability, and the asset which you are saying that you have transferred to them will be called as a given on hypothecation or a mortgage. Asset is given on mortgage for taking loan. Asset is on mortgage for taking loan. Is it clear, everyone? And we'll record it as a finance liability. I hope it is clear to everyone. Okay, fair enough, guys. So let's take a quick break of 5 minutes, and then we'll resume back and start the next topic, that is property, plant and equipment, and the further topics, and also we'll take up a question today. Okay, so let's take a quick break of 5 minutes. Uh, Welcome back, guys. Let's resume our classes. So enjoyed the break. Many times I listen to the students and they say that the most interesting part of a live class is the break. Okay, now let's start the next topic, that is topic 2 on property, plant and equipment. Understand, guys? Okay, so property, plant and equipment, the meaning. Understand, as we discussed that property, plant and equipment are non-current assets, right? All of us know that property, plant and equipment are non-current assets. Now when we say non-current assets, understand what is the purpose of a property, plant and equipment. So the ultimate purpose of a property, plant and equipment is it is held for use. It is held for use. Understand? It is held for use. Okay, it is held for use. Now use can be multiple. Use can be multiples, right? Like production or supply of goods or services, or it can be used for admin purposes like corporate offices, right? And it can also be held for rental to others. Now, if the students have studied the standards properly, they will create a confusion here. They will get a confusion here. What confusion? Sir, I'm linking it with investment properties. Investment properties are the properties which are given on rental to others. How come rental is coming here? How come rental is coming here? Tell me, how many of you are getting this query? How many of you get this query? Tell me. This is generally a common query that I encounter. A common query. Let's say rental to others. How is it coming here? It should go in investment property. Tell me, anyone who faces this query? Understand. Property, plant, equipment has two type of assets. One is property, and one is plant and equipment. See, the rental of property is covered under investment property, but the rental of plant and equipment is covered under property, plant and equipment. Okay? Is it clear now? Siddhant, Neha, are you understanding the point? So the rental of property is covered under investment property, but the rental of plant and equipment are covered here. Are you understanding now? Because see, the term what says investment property. Does it say investment property, plant and equipment? No, it says investment properties. So the rental of property is covered under investment property, that is under IAS 40, and the rental of plant and equipment is covered under this standard with IAS 16. Okay, I hope you are understanding this point. Rental of property is covered under investment property, and rental of plant and equipment is covered under property, plant and equipment. I hope it is clear to all of you. Now comes the recognition. Principle. The recognition principle are two things. First, from that asset I should have economic benefits in the future. Right? And for that asset, the cost can be measured reliably. Okay. Now comes the measurement. Initial measurement. Understand? Initial measurement is at cost. Now comes the question, what is the meaning of cost? So cost means purchase price. Cost means what? Additionally, cost means purchase price plus, it means purchase price plus I can write here minus. I can write here discounts or rebates. I can write here plus non-refundable taxes, right? Plus I can write here any other directly attributable costs. Right? So this is the purchase cost. See, understand, it includes directly attributable costs and it includes provision for decommissioning costs. But understand, it excludes finance costs. Let's suppose if any asset is purchased on deferred credit terms, which we say it normally as EMI. Let's suppose we are paying EMI of 10, we are paying 4 EMIs of rupees 50. So will I say that my asset is at valued at 200? If I am paying 4 EMI of rupees 50 each, so will I say that my asset should be capitalized at 200? If it is EAI paid annually every year, okay, let's not say EMI, let's say EAI, equal annual installment, for 4 years, 50 rupees every year. Can I say it is my asset should be capitalized at 200? No, I have to capitalize my asset at present value, and if the present value, let's suppose, comes to 160, so I will recognize it at 160, and I am excluding the finance component, I am excluding the finance cost component, okay. Now this is the initial measurement. Now comes subsequent measurement. So understand, subsequently the asset has to be measured at cost model, or it can be measured at revaluation model. Understand, in cost model, how do we measure? Original cost minus accumulated depreciation or accumulated impairment losses. Now in revaluation model, what do we do? Fair value of the asset minus any subsequent depreciation. Let's suppose I fair value the asset today, so I will subsequently I will charge depreciation over the remaining useful life, okay. Now minus any subsequent impairment losses. So understand, any subsequent is an important term here, okay. What is charged in the prior doesn't matter to me now. After fair valuation, what is charged subsequently is what matters to me. I believe you guys are clear. Now whenever you do fair valuation, you will have a gain or you will have a loss. The gain or loss has to be transferred to revaluation reserve. Revaluation reserve. Let me write it off. Revaluation reserve. Any excess is transferred to P&L. What is the meaning of any excess? Let's suppose I did the revaluation for the first time. Okay, and I had loss. I will transfer it to P&L. I did the revaluation for the first time and I had gain. I will transfer it to revaluation reserve. I did subsequent revaluation, okay, and in the first time revaluation I had gain. Second time revaluation when I did, again I had gain. I will transfer it to revaluation reserve again. And the third time when I did the revaluation, again I had loss. I will adjust this loss with the revaluation reserve. Again I had loss. Okay, in the next year again I had loss. Okay, then I will again adjust with the revaluation reserve. Let's suppose the balance in revaluation reserve is 100. The balance in revaluation reserve is 100. But the revaluation loss for the current year, is 120. So what will I do? Will I write a negative 20 revaluation reserve? No. I will transfer this excess 20 to P&L. I hope you are understanding, everyone. Please confirm. Is it clear, everyone? Please confirm. Is it clear, everyone? Now, one more point. Let me add the space here. Point number is 4. Treatment of revaluation reserve. Okay. Understand, guys. Revaluation reserve can be treated in two manners. One or two. I am writing here or. One is revaluation reserve is transferred to retained earnings. At the time of on disposal of asset. Second option, revaluation reserve is transferred to retained earnings every year over remaining useful life of asset. Is it clear, everyone? Please confirm. Option number 1 and option number 2. Is it clear, everyone? The question will specify. If the question is silent, assume this one. If the question is silent, assume this one. If the question clearly specifies this one, then only assume this one. Then only take this one. If the question clearly says this one, only if question clearly says. Only if question clearly says. Okay, then only take this one. Otherwise, assume this one. I hope it is clear, everyone. I hope it is clear, everyone, so far. Now, moving on to the next topic, that is investment property. Tell me, guys, is it clear so far, everyone? Now, moving on to investment property. As we discussed the investment property in few minutes back, let's discuss the meaning of investment property now. See, investment property basically is held for rental to others. As the name itself says, you have taken it for investment. Right? You have taken it for investment. So, investment means you are given it for rental to others, or it is held for capital appreciation. Now, understand what we see. We generally, as a student, we generally focus on these two parts. You know what we miss? We miss this part. We generally miss this part, that it is talking only about property. What is the meaning of property? Either land or building or both. It is not covering anything else. It is covering only land or building or both. It is not covering anything else. Guys. Be very much confident about it. It is not covering anything else. Is it clear, everyone? Now, understand again. Coming to the second part, recognition principles. I'll tell you guys, for property, plant, equipment, for intangible assets, for investment property, the recognition principle remains the same. What is the recognition principle? The recognition principle is future economic benefits are probable plus cost can be measured reliably. Right? Is it clear, everyone, the recognition principle? Again, coming to measurement. Initially, the asset will be measured at cost, and we have already discussed the meaning of cost. So not discussing it again. Subsequently, the investment properties can be measured at either at cost model, or it can be measured at fair value model. See, the cost model of investment property is exactly same as PPE, but the fair value model is not the same as PPE, It's not the same as PPE. There is a difference. Now, what's the difference? Let's analyze. Tell me when you have a revaluation gain or loss on PPE, where do you transfer it to? Tell me, where do you transfer it to? I need answers, guys, from all of you. Please make it an interactive session. Guys. Come on. When you have a gain or loss on revaluation of a property, plant, and equipment, where do you transfer it to? Revaluation reserve, right? Revaluation reserve. Now, in this, we will transfer it to P&L. Revaluation reserve is a part of OCI, and then it gets transferred to equity. Okay. Now, frequency. Tell me what is the frequency? Guys. Come on, tell me what is the frequency? Tell me. In property, plant, equipment, right? Once in 3 to 5 years, right? Here the frequency is every year. The frequency is every year now. The frequency is every year. The frequency is every year. Depreciation. Tell me, do we charge depreciation subsequently? Do we charge depreciation subsequently? Yes. How? Fair value of the asset divided by remaining useful life. Divided by remaining useful life, right? So here no depreciation. Here no depreciation. Here no depreciation. Here no depreciation. You guys know there is no issue when we do live streaming. There is a 5 seconds lag. Okay, when the message that you send and when it comes to me. Okay. Now, so this is the difference. This is the difference. This is the difference. Are you understanding? Now, one more point, which I want to discuss with you. Understand? Black pen, yeah. Class of assets. Now, see the choice of opting for cost model or revaluation model. Can we apply asset by asset or class by class? Tell me. Is it done asset by asset or class by class? Tell me. A model, it should be same for a class. It should be same for a class, right? It should be same for a class, right? Now it says that investment property itself is a class. Okay, so if you are applying fair value, then apply for all investment properties. Okay, I hope you are understanding this point. I hope you are understanding this point. Okay, now comes the transfer. Very important topic and easy, but yes, a student generally gets confused in this topic. Generally, understand transfers. See what happens. What happens basically. The PPE and now see when transfer will happen, it will happen only for land. It will happen only for what? Land or building or both. Why? Because see, property can have plant and equipment also, right? But plant and equipment cannot transfer to investment property. Plant and equipments cannot be transferred to investment property, right? So we are discussing only about land, building or both. If a question comes up about plant and equipment, will you assess about transfer? No. Understand? What happens? Standard says whenever you have to transfer a PPE to investment property or investment property to PPE, like other way around, both way around. Okay. First assess whether there are indicators of transfer. What is the meaning of indicator? Now let's suppose one fine day I woke up from my bed and I thought that okay, this studio I want to convert it to investment property. Can I do that? This studio I'm using for my own purposes. This is my property. This is my property, plant and equipment. Can I classify it as investment property? No. There should be indicator for that. What is the indicator? The indicator can be I have vacated this studio and I have opened it for rentals. Okay, I have vacated this studio and I opened it for rentals. Okay, that's indicator. So first assess whether there are indicators for change in classification. If there are indicators, then how to do the classification? Change in classification. Standard says till the date of transfer, till the date of transfer, till the date of transfer, apply the old policy. After the date of classification, after, I'm not saying from, I'm saying after subsequently, see, mark my words here, I'm writing it subsequently, and I'm writing it till date of transfer. I will follow old policy, I will follow old policy, and after the date of transfer, after the date of transfer, after the date of subsequently, I will follow new policy. I hope you are understanding this part. Right? Let me write here also. Evidence should exist. Very good. Who is this? Nuthan. Very good, Nuthan. Evidence should be exist. Evidence should exist. Then only we can transfer. Okay. Till date of transfer, we have to do. I will give you one example. I'll give you one or two examples. Now, example, I'll give you example also so that it will give you clarity. Let's suppose PPE is under fair value model, and we have to transfer to investment property at cost model. Okay. Now, see, first thing, fair value on date of transfer, will become cost for investment property. Fair value date of transfer. Now, the fair value gain or loss till date of transfer will adjust where? Tell me, as per old policy, where should I adjust? Where should I adjust? P&L or revaluation reserve? As per old policy, tell me. Tell me, guys, come on. Revaluation reserve, very good. Revaluation reserve. We should adjust in revaluation reserve. We should adjust it in the revaluation reserve. Very good. Now, so this was an example. Now, one more example I'll take it up. One more example I'll take up. Let's suppose PPE is at cost model. I'm transferring it to IP at fair value model. Okay. Now, so now fair value on date of transfer will become the fair value of investment property. But now what about the fair value gain or loss? Let me see who can answer this correctly. Till date of transfer. Fair value gain or loss till date of transfer. Tell me, where will it get transferred? Revaluation reserve or P&L? Let me see who can answer this correctly. This is my question. This is my question. I'm highlighting my question. Let me see who can answer it correctly. Fair value or loss, fair value gain or loss till date of transfer. Where will we adjust? Revaluation reserve or P&L? Wonderful answer, Neha. It should be adjusted with revaluation reserve. Why? Because old policy is PPE. Old policy is PPE, and PPE, the fair value gain or loss, is adjusted with revaluation reserve. Right? Though it is under cost model, I understand, but still, irrespective of that, if it would have been under fair value model, we would have adjusted under revaluation reserve, and that's what we'll do here also. Is it clear, everyone? Is it clear, everyone? The transfers. Is it clear, everyone? The transfers. Now, moving on to the topic 4 for the day. That is intangible assets. That is intangible assets. Again, a very small topic and a very important topic for the exams. Now, understand intangible assets. What is the meaning of intangible assets? Now, again, though again the intangible assets are again non-current assets. Intangible assets are again non-current assets. But understand, intangible is something which doesn't have any physical substance. So now understand. Let me see. Understand, guys. When I say intangible assets is some asset, is a non-current asset, which does not have physical substance. So can I say loans given to some company is an intangible asset? That doesn't have any physical substance. That is a non-current asset. So can I say that it is an intangible asset? Can I say that it is an intangible asset? Tell me, can I say? No, no, why? Because it is a monetary asset covered under financial instruments. It is a monetary asset covered under financial instruments, right? Now, so it should be non-monetary in nature. It should be non-monetary. Why? Because the monetary assets are covered under financial instruments, and it should be separately identifiable. It should be separately identifiable. If all the three categories are set, if all the three conditions are satisfied, then only we can say. See, I have written here plus. I have not written or. I have written here plus. Okay. If all the three conditions are satisfied, then only we can say that this is an intangible asset. Okay. Recognition principle, again the same. Recognition principle is again the same. What is the recognition principle? Future economic benefits are probable plus cost can be measured reliably. Cost can be measured reliably. Right, this is the recognition principle. This is the recognition principle. Now coming to measurement. Measurement initially again is done at cost. We have already discussed the meaning of cost, so I'm not discussing it again. Now subsequently again it can be measured at cost model, and the cost model meaning is again same as PPE, or it can be measured at fair value model. Again on a class by class basis. But understand one thing, we can apply fair value model to an intangible asset only if an active market exists. Why I am saying active market? Give an example of intangible asset is a brand name. Guys, tell me, is brand name something which is traded with sufficient volume in the market? No, right? Brand name is something very particular to an entity. Something very particular to an entity, right? So determining the fair value of that is a very difficult task, right? And even if I can calculate the fair value, it can be manipulated. Right? So the standard says that we can apply fair value model to an intangible asset only if it has an active market. Like let's suppose a license, right? Accounting software license which are taken, that is traded with sufficient volume in the market, right? So we can say that that there an active market exists, and we can say that a fair value model to those assets. Okay. Now what about internally generated intangible assets? Now understand, guys. Internally generated intangible assets. Is it clear so far, everyone? Is it clear so far, everyone? Anyone having any queries so far? Okay, fair enough. Let's start. Internally generated intangible assets. What is it? See, whenever we internally generate something, okay, there are always three phases for that. One is the research phase, where we research about that, okay, where we research and obtain knowledge about it, Then comes development phase, where we apply the knowledge gained in the research phase and develop the asset. And then comes the developed phase, where the asset is developed and it started giving me benefits. Now, so standard says whatever expense you incur in a research phase, whatever expenses you incur in a research phase has to be transferred to P&L. Why? Understand, the reason is the research might be successful, might not be successful. Right? So, but it will be incurred irrespective of it is successful or not successful, right? This cost should be incurred, right? So I will transfer it to P&L. In development phase, till the time pay rate is not satisfied. Now what is the meaning of pay rate? Pay rate means, I'll write it separately. Pay rate. Pirate means future economic benefits should be there. Okay. Costs. Now understand, I write it like this. Resources which will be required, the resources which will be required to this for the construction, for the development are available. Resources are available. Entity is willing to construct also. Entity is willing to construct also, or you can say entity has intention. Okay. Entity has ability also. Okay. So there are 4 or 5 conditions given in a book, which you can read from the book directly. But when all these conditions get satisfied, pirate, when all the 5 conditions, when all these 6 conditions get satisfied for the pirate, from that date, okay, I can start capitalizing the cost. Okay, and keep it under intangible assets under development. But will I depreciate this? No, I will not depreciate. Now once the asset enters the development phase, then I will start depreciating the asset. Are you understanding this phase? Everyone, tell me, guys. All of you. Okay. Now understand. Self-generated intangible assets, like goodwill. Self-generated intangible assets like goodwill, brand, customer lists, etc. cannot be recognized. Can you tell me why? Can anyone give me reason why? Let me see who can answer this reason. These assets cannot be recognized. Goodwill, which is self-generated, not in business combination. The goodwill which is acquired in business combination is definitely recognized, but the goodwill which is self-generated. Let's suppose I have my coaching center and I have been teaching it from the long time. So a goodwill gets created, right? In the market, a goodwill gets created, right? But I cannot recognize that goodwill. Why? Neha, not separable. No, Neha. Cost cannot be measured. Very good, Yogesh. Because the costs cannot be measured. Now link it with the this one. Recognition principle. What is the recognition principle? Future economic benefits are there and costs can be measured reliably. So for these, definitely future economic benefit exists, but costs cannot be measured. And hence we cannot recognize, it. Wonderful answer, everyone. Neha, Yogesh, Garima, Nutan, wonderful answer. So this is all the topics that we have discussed today. Now we have a question to practice, that is the practice to pass. We have to practice certain questions that we have to pass the exam, right? So I have taken up a question from your SBR past exam, that is December 18 question paper is there. This is a December 18 question paper. Okay, this question came up in December 18. So I have taken up a question. Now let's read the question and try to answer it off. Okay, this is not a full-fledged question. I have just taken a specific portion of the question. Okay, now let's read the question and try to answer it off. Understand, guys? I believe the question is clearly visible to all of you. Please confirm, everyone, and then we will start the discussion of the questions. Fair enough, Yogesh. Now, the following is an extract from the financial statements position, from the statement of financial position of Fiskerton, a public limited company, from Fiskerton. A public limited company, as at 30th September 20x8. Now, it says that the entity had these non-current assets, current assets, non-current assets, current assets, then equity share capital, then other components of equity, then retained earnings, then non-current liabilities, and then current liabilities. Okay. Now, these are the assets and the liabilities. The bank loan, now see, the non-current liability is a bank loan. The non-current liability is a bank loan, right? Now it says, the question says that, see, read this line. The bank loan has a covenant attached whereby it will become immediately repayable should the gearing ratio, that is long-term debt to equity of fiscal turn exceed 50%. Meaning thereby it says that if the debt by equity exceed 50%, the loan will become repayable. The loan will become repayable. Okay. Now, further, see, this is a very important statement. This is a very important statement. See here, fiscal turn has a negative cash balance. Negative cash balance. See, link guys. If this ratio is this, if this covenant is not matched, loan will become what? Repayable. If the loan becomes repayable, I don't have cash also, negative cash. Tell me what is it trying to indicate? What is it trying to indicate? Tell me. What issue it is trying to indicate? Tell me. What issue is the question trying to indicate? Tell me. What issue? Please apply logic. Loan might become repayable, and the loan is also, see, substantial portion, 50,000, right? So basically it's 50 million loan. So that's this is raising a going concern. This is indicating towards going concern. Though I'm not sure basically it will be a going concern or not, but yes, it is indicating towards going concern, is I'm sure. Now coming to the question again. Let's read the question again. What does it say? Hallam property. Okay, Hallam property. Included within the non-current assets of fiscal term is the property in Hallam, which has been leased to Edingley under a 40-year lease. Okay, basically see here. I will use this color pen now. Non-current assets. See, it's talking about what? Property. It's talking about a property in Hallam. Okay, leased to Edingley for a 40-year lease. Leased to Edingley on a 40-year lease. The property was acquired for 20 million on 1st October 2007 and was immediately leased to Edingley. I purchased and immediately leased. Now see, the asset was expected to have, now guys, see here what is happening here. The asset is expected to have a useful life of 40 years. The lease term is 40 years, the useful life is 40 years. Tell me what is the question trying to indicate? What is the question trying to indicate? The lease term is 40 years and the useful life is 40 years. Finance lease, wonderful answer Neha, okay, finance lease, the question is saying about finance lease. Now at the detail and have a minimal residual value. Fiscal, now see what is it trying to do? See, Fiscal Turn Limited has classified the building as an investment property and has adopted the fair value model. Is it correct? 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 Come on guys, tell me, is it correct? Don't you think they should ideally de-recognize the property because it's on the finance list? Wonderful answer, Nutan, right? Garima is on different, it says PPE. Garima, understand, it's on finance lease, they should ideally de-recognize the asset. Right? There is no question of PPE and initial property. The question is about, Neha, again Neha, from where the question comes of ROU? I have given the asset, I am a lessor. Do I recognize ROU? Neha, come on. I am a lessor. I will de-recognize the asset and I will recognize lease receivables. See here. Again, what they have done, what mistake they have done. See here, continue with the old mistakes. See, the property was initially revalued to $22 million on 31st March 2008. Okay, interim financial statements had indicated that the gearing was 51% prior to this revaluation. Okay, fine, we'll assess it off. The managing director was made